You've had a bank account for years. You trust it completely. Your salary goes in, your rent goes out. You check the balance sometimes. You maybe earned a few rupees or cents in interest last year. Here's what you haven't thought about. While your money sits in that account, the bank is using it, lending it out, charging someone else 15% interest on it, and paying you next to nothing in return. Your savings account is functionally a free loan you're giving the bank. And that's just the beginning. Today, we're covering exactly how banks make money, including the parts they never put in the brochure. The running example. We're going to follow one fictional $1,000 through the banking system. Call it the Ahmed 1,000. Ahmed just got paid, deposited his money, and went home thinking it's sitting safely in a vault. It is not sitting in a vault. Let's track where it actually goes.
What a bank actually is. Strip away the marble floors and the app with the nice UI. A bank is a middleman. On one side, people with money they're not using right now. On the other side, people who need money they don't have yet. The bank sits in the middle, borrows from one group cheaply, lends to the other group expensively, and keeps the difference. That difference between the interest rate they pay you and the interest rate they charge borrowers is their core business. Simple, unglamorous, extremely profitable. Fractional reserve banking. This is the concept that makes the whole thing work, and it's weirder than most people know. When Ahmed deposits his $1,000, the bank doesn't lock it in a box with his name on it. The bank is legally allowed to lend most of it out. This system is called fractional reserve banking. The bank keeps only a fraction of deposits on hand as reserves. The rest goes out as loans. Historically in the U.S., banks were required to keep around 10% in reserve. That means if you deposited $1,000, the bank could lend $900 of it out. In March 2020, the Federal Reserve actually reduced reserve requirements to zero, meaning, in theory, the limit is now based more on other regulations and capital requirements than a strict percentage. So the Ahmed 1,000 gets deposited, the bank keeps some in reserve, the rest gets lent to someone else, maybe as a mortgage, a car loan, a business loan. That borrower pays interest. Ahmed gets almost nothing. The bank gets the spread. The money multiplier? Here's where it gets genuinely mind-bending. That $900 the bank lent out, the borrower spends it, pays a contractor, buys a car, whatever. That contractor deposits the $900 into their bank. That bank now lends out most of $900. The cycle repeats. Starting from Ahmed's $1,000, the banking system can, through this chain of lending and depositing, create a much larger total amount of deposits circulating in the economy. This is called the money multiplier. Banks are, in a real sense, expanding the money supply just by doing their normal business. Your deposit doesn't just sit there. It's generating economic activity and bank profit multiple times over. Net interest margin, the main engine. Now we can explain the core profit model. Banks borrow money cheaply from your deposits. They pay you, say, 0.5% interest on your savings account. They lend money expensively. Mortgages, car loans, personal loans, credit cards. They charge borrowers anywhere from 4 to 5% on a mortgage to 20+% on a credit card. The gap between those two numbers is called the net interest margin, or NIM. Net interest margin is typically the largest source of bank revenue. Industry data suggests it can account for roughly 65% of a bank's operating revenue on average. To make this concrete with the Ahmed 1,000, Ahmed's $1,000 earns him about $5 in a year at a low savings rate. The bank lends that $1,000 to someone on a credit card at 20% interest. The bank earns $200. It paid Ahmed $5. Net profit on the Ahmed 1,000? Roughly $195. Ahmed got a free app and a debit card.
The fee machine. Interest income is the main course. Fees
are the side hustle that never stops. Banks have built entire revenue streams out of charges you barely notice. Let's run through them. Overdraft fees. You spend more than your balance. Bank covers it. Bank charges you. In the US, typically up to $35 per transaction as of 2025. In a single day of multiple purchases while overdrawn, this can stack fast. In 2023, customers in the US paid over $5.8 billion in overdraft and non-sufficient funds fees combined. That number is not a typo. Monthly maintenance fees. Charged just for having a checking account if you don't meet minimum balance requirements. It's a fee for the privilege of storing your money somewhere. ATM fees. Use an out-of-network machine, pay twice. Once to the machine's bank, once to your own bank. For withdrawing your own money. Interchange fees. Every time you swipe your debit or credit card, the merchant's bank pays a small fee to your bank. You don't see it. The merchant kind of absorbs it. But banks collect billions this way across millions of transactions. Wire transfer fees, foreign transaction fees, paper statement fees, early withdrawal penalties on CDs, the list goes on. Non-interest income, fees and service charges can make up roughly 35% of a bank's total operating revenue. That's a significant second engine.
The Ahmed 1000, Fee Edition. Ahmed uses his debit card 30 times a month. Each swipe generates a small interchange fee for his bank. Ahmed accidentally overdrafts by $3 buying lunch. Fee, $35. Ahmed's account doesn't maintain the minimum balance. Monthly fee, $12. Ahmed uses an ATM near his office that's out of network. Fee, $3 from that ATM, plus $2.50 from his bank. Ahmed has had this bank account for years and never thought about any of this. The bank thinks about it constantly.
Why your savings rate is so low. This isn't a coincidence. The bank wants the spread between what it pays you and what it charges borrowers to be as wide as possible. The less it pays you, the more it keeps. A standard savings account at a big traditional bank often pays somewhere between 0.01% and 0.5% annually. That's essentially nothing. Meanwhile, the same bank might be lending money out at 7% on mortgages or 20% on credit cards. High-yield savings accounts, usually at online banks or fintech platforms, pay significantly more, sometimes 4-5%, because they have lower overhead than traditional banks with physical branches. They pass more of the margin to you to attract deposits. Traditional banks with expensive branch networks don't have to offer much. You already bank there. Your inertia is their business model. The central bank and how interest rates change everything. Banks don't operate in a vacuum. There's a bigger player, the central bank. In the US, that's the Federal Reserve. In Pakistan, that's the State Bank of Pakistan. Every major country has one. The central bank sets a base interest rate, often called the policy rate or federal funds rate. This is roughly the cheapest rate at which banks can borrow from each other or from the central bank itself. When the central bank raises rates, borrowing gets more expensive across the board. Banks charge more on loans, but they also tend to pay more on deposits, though not always by as much. When rates go up, banks with large loan portfolios typically earn more. Their net interest margin expands. When rates are near zero, like they were for much of the 2010s, bank margins compress. Banks make less on lending, so they lean harder on fees. This is why when rates were very low, banks were aggressively pushing credit cards, investment products, and fee-based services. When rates rose sharply from 2022 onward, bank profits followed. The Ahmed 1000 is worth more to the bank when rates are high, less when they're low. The one thing banks fear. The fractional reserve model has one enormous vulnerability. Since the bank only holds a fraction of deposits in reserve, it can't survive a situation where everyone tries to withdraw at once. This is called a bank run. Historically, bank runs have destroyed even well-run banks. If enough people panic and demand their money simultaneously, the bank runs out of cash.
Even if it has assets, those assets are tied up in loans that can't be called back instantly. The Great Depression in the U.S. triggered massive bank runs. More than 1/3 of banks failed in the years before the FDIC's creation. Wikipedia. In response, the U.S. government created the FDIC, the Federal Deposit Insurance Corporation, in 1933. Since the FDIC was founded in 1933, no depositor has lost a penny of FDIC-insured funds. FDIC. The FDIC currently insures deposits up to $250,000 per depositor per bank. If your bank fails, you get your money back, up to that limit. This single policy change is what makes modern banking psychologically stable. People don't panic withdraw because they know their money is protected. Without the FDIC, Ahmed would be sweating every time a rumor spread about his bank.
Credit cards, the premium product. Let's spend a minute on credit cards because this is where banks extract the most profit per customer. The model is elegant in a, wow, that's aggressive kind of way. The bank gives you a credit card. You use it. If you pay the full balance every month, you pay 0 interest. The bank makes only interchange fees off you. You're what the industry calls a transactor, low value. If you carry a balance, if you pay only the minimum, you start accruing interest. Credit card interest rates are typically among the highest in consumer lending, often 18 to 25% annually or more, depending on the market. The bank has now converted you from a zero-cost customer into an interest-generating asset. And because minimum payments are designed to be small, most of the monthly payment goes toward interest, not principal. The balance shrinks slowly. The interest keeps coming. The Ahmed 1000, sitting on a credit card at 20% interest, earns the bank $200 a year, while Ahmed thinks he's just using his card.
Investment and wealth management arms. Big banks don't stop at deposits and loans. Major banks typically have investment banking divisions that advise companies on mergers, acquisitions, and IPOs, charging significant advisory fees. They have wealth management arms that manage investments for high net worth clients, charging annual percentage fees on assets under management. They have trading desks that speculate in financial markets. They issue and manage credit cards. They sell insurance products. A large modern bank is less of a safe place for your money and more of a diversified financial services conglomerate that happens to also hold your deposits. Your checking account is just the front door.
What this actually means for you. Okay, so the bank makes money off you. That's fine. Businesses make money. But knowing how changes what you should do. Your savings account rate matters more than you think. Moving money from a 0.1% traditional savings account to a 4-5% high-yield savings account is free money. The bank you're at right now is counting on you not doing this. Overdraft fees are entirely avoidable. Turn off overdraft protection if your bank charges for it. Most banks now offer the option to simply decline transactions instead of covering them and charging $35. Choose the decline. Credit cards are fine if you pay them in full. The bank is rooting for you to carry a balance. Don't give them the interest. Use the card for the rewards, pay it off monthly, walk away. Minimum balance requirements are worth paying attention to. Many fee-free accounts exist. You shouldn't be paying monthly just to keep an account. Understand your own NIM. What are you earning on your savings? What are you paying on your debt? If you're paying 20% on a credit card and earning 0.5% on savings, you are actively losing the spread. Eliminate the high-interest debt first. Always.
Banks are middlemen. They borrow cheap from depositors, lend expensive to borrowers, and keep the spread. Fractional reserve banking means your deposit gets lent out. It is not sitting in a vault. The money multiplier means one deposit can fuel multiple loans through the system. Net interest margin is the main revenue engine, roughly 65% of bank revenue. Fees are the second engine. Overdraft, ATM, interchange, maintenance, billions collected annually. Your savings rate is low on purpose. Your inertia is the bank's business model. Central bank rates change the whole game.
High rates means bank profits expand. Low rates means more fee pressure. Bank runs are the system's fatal flaw. The FDIC was created to prevent the panic that enables them. Credit cards are the bank's premium product. Carrying a balance is how they extract maximum value from you. The bank is not your enemy, but it is not your financial advisor either. Know how it works? Use it accordingly.
Ahmed deposited his $1,000. The bank said thank you, lent most of it out at multiple times the interest rate they're paying Ahmed, collected fees on his card swipes, and built a mobile app nice enough that Ahmed never thought twice about any of it. That's not a scam. It's just business. The only question is whether you understand the business well enough to be on the right side of it. If this video made you look at your savings account differently, subscribe, because that's exactly the point of this channel. And drop a comment with the dumbest bank fee you've ever paid. I'll start. $35 for being $1.73 overdrawn. The Ahmed 1000 deserved better.